Welcome to the All Financial Hour podcast with Steve All.
Before the election, Steve, you had talked about considering an after-tax Roth conversion to take advantage of some of the lowest tax rates in history. You know, taking that tax hit now, it looks a lot more attractive than taking your chances with higher rates when the 2017 cuts would expire at the end of next year. Of course, Donald Trump won, and of course, he wants to extend those cuts. So not so much urgency there. What are your thoughts on that?
Well, I look at it to the point, I still believe there's urgency. And the reason being is with the Trump tax cuts, I believe they will extend the Trump tax cut. Mm-hmm. Do I think they will actually make them permanent? Because the rule basically said they had to make the Trump tax cuts permanent by the time they sunset at the end of 2025. Well, it didn't come through Congress. It came through the tax rules that they have that they can get it from a 60-40 vote down to a 50-50 vote. Well, they still don't have 60 votes in Congress to make it permanent. So I think we're going to probably get a delay on that. Some of the things, I mean, I've had people call and say, you know, this is utterly fantastic. We're not going to pay taxes on our Social Security and we're not going to do all this. And I said, folks, a lot of those promises that were made probably won't happen. They're kind of non-starters. Why? It's just not viable for us to do that. But extending the time 6 to 8 more years, now I'm looking at it and going, I don't have to do $200,000, $300,000, $400,000 worth of Roth conversions to get it in before that tax rate hits. I believe we're going to have 6, 7 years or more, so I can spread it out over a lot more time. Why? Because then it's less effect on the cost of your Medicare premiums. So we will have a tax bill next year. We will have one because we've got to do something, and I think it'll be the extension of the 2017 Act. So I think that's going to happen. But I don't think all of the things that were talked about during the election cycle are possible are going to get through. But actually, that's where we do it. I get together with a group of people, and we actually get together and talk about what's going on and how can we work within the IRS tax code that would make it the best for our clients. Currently, we're talking about current income. We're talking about Roth conversions. And I am a firm believer that reducing or eliminating taxes in retirement is the best thing that you can do for a successful retirement.
Now, Steve, are you already dreaming about Thanksgiving?
Oh, yeah. I mean, I'm heading down to Florida. I think I fly down there on Wednesday, and we've already got reservations somewhere. I don't know where it's at.
Wait.
Reservations? We've already got Hey, people ask what's my favorite thing to make, and I say reservations.
Oh, my gosh,
the only day that I really don't like doing it is Thanksgiving, because I think the magic of Thanksgiving is leftovers. I mean,
true, yeah,
very
true.
I know my wife will be in that kitchen all day long preparing everything, and then it takes us about 25 to 30 minutes to tear through it.
And then it's over, yeah.
And then it takes another hour to clean it all back up or two. So, it goes from there, but it's just me and my wife. Kids are in different areas now. Megan's up in New York. Matthew's out in Colorado. Leslie's pretty well with child to the point where it's not really good to fly. So it's going to be myself and Lori. So I look at it at the point, hey, let's just do reservations, because I hate to say it, that is my favorite thing to make.
Oh, man.
Is reservations. I know. So let's flip it the other way.
Okay.
What are you all doing for Thanksgiving?
Well,
how much, you always get to ask me the questions.
Okay.
Let's go the other way.
Well, listen, I have the easy job this year. I'm actually going to my in-laws' house. So my gift is flying up to see them. That's what I'll be contributing to the meal.
Yeah.
But usually we've always hosted at my house. I've done the turkey and the pies and the cranberries. I've done it all. So this year I'm going to kick back, put my feet up, and enjoy.
Okay, that's fantastic. I do agree with, if you're not making reservations, go somewhere else. Yeah, I like that thought process.
That's
so,
right.
Yeah, Thanksgiving, no, I hate to say it.
Oh, man.
We're not going to do the turkey and all the stuffing and all of the things for two of us.
Well, listen,
It's just
I'll have
not
to eat.
necessary.
I'll eat some leftovers for you. Okay.
Please,
Okay.
or ship me some.
I'll send you a
in.
picture. I'll
Next
text
week's
you a
show,
picture.
I'll eat it. Yeah, thank you very much.
There you go.
Make me hungry.
There you go. Well, listen, just as much as people sit back and they fantasize over the best turkey or their favorite stuffing or the dessert that's their favorite, you can think the same thing about retirement, right? People sit back and they daydream about retirement, how beautiful it's going to be. And we asked financial author Patrick Kelly, what should the turkey and potatoes be of our retirement plan? Listen to this.
The thing that I have been such a big proponent of for individuals, especially if they're in or near retirement, is this incredible, innovative product called a fixed index annuity. What's so great about that is it gives them the opportunity to still capture inflation-beating returns, but has no possibility of loss due to the market. And I just think if you can be in a position where you know, no matter what happens in the market, you still got your meat and potatoes.
So, Steve, what would you say is the meat and potatoes when it comes to putting together retirement strategies with you?
And I think the tool that he talked about was an excellent tool. I think if you look at me, the meat, income, and income. How am I going to replace that paycheck in retirement? So I think that's the big thing. The potatoes that he talked about. I don't want to lose money due to market volatility. I can't put all of my assets into that fixed index annuity, but I can put a portion of it. Too much of anything is never a good thing. So I'll look at that. Meat and potatoes, income, and protection. What am I doing to protect the gains that I've had over the last 2 years? And how am I going to replace that paycheck in retirement?
Now, just when you thought the stock market couldn't go any higher, it did exactly that after Donald Trump won the election. So what's behind the surge? Well, here's financial advisor Jamie Cox on Fox Business.
The Fed has only lowered interest rates 3 times outside of a recession. And in each of those 3 times, the market has been up double digits 1 year later. And so irrespective of the political environment, just the fact that you had a reasonably strong economy with a lowering interest rate environment, you had the setup for stocks to go up anyway, but then you turbocharge it with the deregulation and also the tax policy sort of being a lot more pro-growth. So that's what you see. It's investors really, really piling into stocks. And I think that's going to be the key. You're going to see it around the world. It's not just going to be in the U.S.
All right. So, Steve, I've heard some warn about the Trump bump, that could be followed by a Trump dump of stocks. So are you warning clients about getting caught up in the excitement and having too much risk out there?
I get calls from both. When presidential elections come down, I can promise you I get calls from both sides of the aisle. If my guy won, then let's just go for it all. If my guy lost, the world's going to go away in a handbasket. So let's just go to cash. And I think both of those are emotional reactions to the market. So let's look at it. The Trump bump, what has happened since then? It's kind of calmed itself back down. Why? Because market cycles include 10% declines, what we call corrections, and bear markets, 20%. It's going to happen. But the idea around it of it is I've had 2 good years. Have you looked at it and said, what am I doing to protect some of those gains? And that's why I look at it with the market guard. We have different types of models for different peoples. Our static models, it rebalances for drift every 366 days and or when necessary. We'll do that. Well, what do I mean? Well, if I had an 80-20 portfolio and I've had a good run up again this year, I might not have an 80-20 portfolio anymore. I might have a 90-10. So I'm overexposed in the stock side. And what happens when markets get too high? Usually they will start to decline. So I might be overexposed. And if it was one of those years where the market was down, my 80-20 might be a 70-30. So I believe it's always important to rebalance back to that state so that whatever the market does, I don't take extra exposure or I'm under exposure when it switches. And then we have target models. Target models say if there's a lot of headwinds out there, let's be defensive. Let's not go for it all. So we've had a few things going on. Prior to just a couple weeks ago, we had a presidential election. We weren't sure what was going to happen. Mm-hmm. We still have a Federal Reserve that we're not sure exactly what they're going to do. How are we going to lower those interest rates? Is inflation going to come back if we start putting tariffs on other countries? So are we going to have higher costs? What's happening over in the Middle East? Israel throwing bombs at each other. Let's look at it and say, what's going to happen here? So we've got enough headwinds out there that says, let's move away from that market exposure when we have the headwinds, and we'll move back in when we believe those times are there. And then we also have stock funds. And I think the greatest thing about stock funds is everybody goes, well, the market's in all-time highs. I can't go into stocks. And I look at it and say, well, there's an opportunity in the stocks. It's which one are we going to buy? And I look at the market guard as kind of like needles in a haystack. The haystack's all the stuff out there. Needles are those individual stocks. And if we run a magnet over the top of it, the needles can come up to the magnet. And then we analyze those and figure out which ones do we want to have. We don't really care if they're large cap, mid caps, small caps, value, growth. Which ones fit the mathematical model? And then reevaluate that on a quarterly basis. So we have stock opportunity funds, stock dividend funds. We have emerging technology where I'm investing today for the technology in the future. Also have the availability to cover blockchain. So I can be as aggressive as you want to be, or I can be as conservative as you want to be.
A woman recently wrote into an advice column on MarketWatch.com, and she has this to say. She says, I'm 67. My husband's 70. We've saved $1.2 million for retirement, and it's making 5%. We get $2,900 each month from Social Security. My husband insists on living only on Social Security, but I've worked hard through my life and I want to enjoy my retirement. What do I do? Steve, how do you handle this?
Our system for retirement used to be built on a three-legged triangle. Many, many years ago, people had pensions, Social Security, and personal savings. So that three-legged stool was very steady. It gave people that added peace of mind when it came to it. Then what happened? Well, we don't have the pensions that we used to have. Mm-hmm. Certain industries have them, government has them, but it's not as big in the, quote, business world. Now we're looking at the fact, Social Security. Is it teetering? Yes, they're going to have to do something about Social Security. I just pray that the current administration or the incoming administration does something about Social Security so we have an idea how to plan for it instead of waiting till that last day to get something done, because we do need to fix Social Security. That, I believe, is very, very important. So it's predominantly personal savings, and that's what they were talking about. We're 67 years old and living on a Social Security check. It wasn't designed for that. Old age survivors disability income. It was for people that have outlived life expectancy to make sure that they've got something later in life. And one of the things that when I sit down with clients is the thing I said is about the worst thing that we can hear as advisors. Mom and dad are no longer here. And then all of a sudden the kids come in. Mm-hmm. And they go, I can't believe mom and dad had this much money. Why didn't they do more? And I think that's our job as the financial advisor, to have that person to come in when we have an election and people get emotional. How do we talk them down off the cliff or bring those emotions back down? And then we can also sit there and say, you're making 5%. You could probably spend another $50,000 to $60,000 a year. Yeah, if there's going to be down markets in that time frame, and you're going to have more than returns higher than that at different times. And it's kind of our job to look at it and say, we believe you're going to be okay. And if we add those extra expenses that you want to put in there, if you have the opportunity to be okay in retirement, let's look at that. It's also my job that I believe if you start overspending, to say, hey, you might want to look at this and back down a little bit. That way you got somebody that's not emotionally attached to it assisting you in your retirement journey. Because that's what it is. It's a journey, not a destination. Let's have as much fun as we can possibly do while we're heading to that destination. So if you're not sure exactly what you can spend in retirement.
Thanks for listening to the All Financial Hour podcast.
Insurance products are offered through the insurance business All Insurance Group, LLC, AIG. All Financial Group, LLC is an investment advisory practice that offers products and services through Impact Partnership Wealth, LLC, IPW, a registered investment advisor. IPW does not offer insurance products. The insurance products offered by All Insurance Group, LLC, AIG are not subject to investment advisor requirements. IPW and All Insurance Group, LLC, AIG are not affiliated companies. Investing involves risk, including the potential loss of principal. Any references to protection, safety, or lifetime income generally refer to fixed insurance products, never securities or investments. Insurance guarantees are backed by the financial strength and claims-paying abilities of the issuing carrier. This radio show is intended for informational purposes only. It is not intended to be used as the sole basis for financial decisions, nor should it be construed as advice designed to meet the particular needs of an individual's situation. All Financial Group, LLC is not permitted to offer, and no statement made during this show shall constitute tax or legal advice. Our firm is not affiliated with or endorsed by the U.S. government or any governmental agency. The information and opinions contained herein provided by third parties have been obtained from sources believed to be reliable, but accuracy and completeness cannot be guaranteed by All Financial Group, LLC.
This radio show is intended for information purposes only.